Welcome to the deep dive. And this is, well, it's a special moment for us.
It really is a true introduction.
Because we are not just starting another deep dive into a set of sources, we're launching something completely new. We're opening the door to a vision we call JStockRadio. So, nice to meet you.
And it really is a new perspective. For way too long, I think, global investors have been operating with these decades-old stereotypes about Japan.
Oh, yeah. The lost decades, this stagnant economy.
Exactly. And that whole narrative, frankly, it's just stale. It's misleading. Our mission here is to bridge that massive gap and show you where the real opportunity is hidden.
Our goal is pretty simple then. We want the world to discover the true charm, the structural safety and the overlooked excellence of specific Japanese companies. And we're talking about the mid to small cap stocks that are consistently ignored by big global media, ignored by the passive index funds.
And just completely misunderstood by traditional Western analysis. To find these kinds of opportunities, you just can't rely on, translated annual reports.
No, or the same handful of reports recycled by the big banks. You need intelligence that's local, granular, and fundamental.
Right.
Which brings us to our primary tool, the bedrock of our analysis, and frankly, our secret weapon, Shikiho.
Shikiho, yeah. Or the Toyo Kizai Japan Company Handbook.
Yeah.
It is essential. Think of it as the gold standard of boots-on-the-ground equity research in Japan.
And it's updated quarterly, which is key.
Crucially. And the research often comes from interviews that are conducted directly by their own company researchers.
Okay, let's unpack why that matters so much to you, the listener. If you're relying on, say, Wall Street analysis, you're usually getting delayed, top-down, kind of qualitative summaries of annual reports.
Right.
Shikiho just cuts right through all of that. It gives you data points like shareholder breakdowns, capital spending forecasts, even internal company guidance that simply don't make it into the English language filings.
And that intelligence lets us look past all the noisy headline news and just focus on rock-solid fundamentals, especially in those undiscovered names. It gives us the ability to define value with real precision.
And that definition, it really has to start by looking at the colossal difference between the U.S. market and the Japanese market right now.
You have to understand the macro landscape first.
So let's jump right into the macro thesis. Because if you're feeling even a little uncomfortable about valuation levels in developed markets, especially the U.S., you are definitely not alone. We have to set the stage by addressing what feels like a massive market driven by, vapor.
It's the elephant in the room, isn't it?
Yeah.
The one everyone's trying to ignore.
Yeah.
We use the Buffett Indicator as a core metric just to gauge some kind of valuation sanity.
Right. So that's the total market cap of all stocks compared to the country's nominal GDP.
Exactly. And historically, it's been one of the most reliable predictors of future market returns.
And what's it telling us about the U.S. right now? The numbers are staggering.
They really are. We're talking about the U.S. market cap sitting at around $61 trillion.
Wow.
Against a nominal GDP of about $30 trillion. So you do that math.
Yeah.
And that puts the Buffett Indicator well over 200%.
200%.
That is just so significantly overvalued. To give that some context, the threshold where markets are historically considered significantly overvalued is 149%.
So we're way past that.
Way past it.
Mm-hmm.
The fact that the U.S. is sitting comfortably at 200+%, it signals that a correction is more than just likely. I mean, it's an inevitability driven by gravity.
The market has just priced in this fantastical, almost unimaginable amount of future growth that might never, ever materialize.
And that's the promise it's built on.
This is the critical distinction then, isn't it? The U.S. market is overwhelmingly growth-backed. Its valuation relies on the abstract value of intangible assets, future expectations, all of it. It's built on the promise of tomorrow.
Exactly. And when we pivot to Japan, we find the complete counterpoint. The Japanese market is fundamentally asset-backed.
Okay.
This isn't theoretical future growth. It is verifiable reality sitting on corporate balance sheets today. We are talking about massive internal reserves, substantial cash, real estate holdings, cross-share holdings.
Tangible assets.
Tangible assets accumulated over decades.
So when people look at the Nikkei hitting new highs and immediately shout, bubble,
Yeah.
they're just missing this profound structural difference. They're applying a U.S. growth market logic to an asset-heavy value market.
That is the key insight. The one thing you need to carry forward from this, the Japanese rally is not a bubble. It's simply a return to fair value.
A return to fair value.
The market is finally acknowledging the profound tangible value that has been sitting dormant on corporate balance sheets for decades.
But wait, let's drill down on that dormancy idea for a second. Why was this value ignored for so long, even by Japanese investors themselves?
A couple of historical reasons. First, you had the 1990s bubble crash. That created a deeply conservative corporate culture where management teams prioritize just hoarding cash and minimizing risk.
Over-rewarding shareholders.
Totally. And second, the system of cross-shareholdings, where allied companies hold stock in each other, it basically created a moat that protected management from any outside pressure.
So the value was always there, the cash, the property, the factories, but the management culture just refused to unlock it.
Precisely. And now, the stability that's provided by those tangible assets is being recognized as smart money begins to migrate. It's moving away from regions that are burdened by all these structural or geopolitical risks, and it's seeking out genuine safety.
Which makes Japan the primary safe haven choice right now.
It really does.
Okay, that movement of capital is the next piece of the puzzle then. We need to connect the dots on why billions are flowing out of other regions and into Tokyo.
Yeah, let's look at the global competitors.
Let's start with the most dramatic contrast. China and Hong Kong.
The divergence there is, well, it's impossible to ignore. China and Hong Kong present these huge geopolitical risks, regulatory unpredictability.
And the real accelerating trend of decoupling.
Absolutely. Global capital, it requires security, not just high returns. And you see that risk translated directly into market performance.
Oh, yeah. Over the relevant period, the Hang Seng Index is down, what, roughly 45%?
45%. Meanwhile, the Nikkei has surged upwards by over 60%.
That's a 100+ percentage point divergence. That tells the entire story.
It tells you where capital perceives safety and where it perceives structural instability. I mean, an investor's main concern in China right now is the safety of their capital itself.
Right.
Contrast that with Japan's rock-solid rule of law. Contracts are protected, capital controls are non-existent.
Okay, what about other high-growth areas that steal the headlines? Like India. It's constantly touted as the next great growth engine.
India certainly has that potential for high-velocity growth, no question. Demographics are on its side, but it still struggles with some really fundamental structural weaknesses.
Like what?
A persistent lack of transparency in financial reporting, for one. And a legal and corporate governance infrastructure that's just, it's still underdeveloped compared to G7 nations. Japan provides that fundamental stability.
And then there's Europe. Legally stable, sure, but often viewed as economically stagnant.
Europe is just caught in a difficult spot. Its legal framework is sound, but it's suffering from a lack of dynamism, a lack of structural innovation, the dynamism that attracts that long-term, high-quality growth capital. It just isn't there in the same concentrated way.
So when you summarize all those challenges, geopolitical risk, lack of transparency, lack of dynamism, Japan's appeal becomes overwhelmingly strong.
It's the perfect storm. You have immense deep market liquidity, the bedrock of the rule of law, ensuring your assets are safe, and most critically, this ongoing massive push toward corporate governance reforms.
Right. Reforms mandated by the Tokyo Stock Exchange itself.
Exactly.
But we've heard about governance reform in Japan for decades. Why should anyone believe this time is genuinely different? What are the regulatory teeth that have been added?
That is the essential question. And the difference now is the direct mandate from the TSE, the Tokyo Stock Exchange. They are specifically targeting companies trading below a price-to-book of 1.0.
And what are they asking them to do?
They're being explicitly asked to disclose their plans for improvement, outlining exactly how they intend to raise capital efficiency, improve profitability, and crucially, enhance shareholder returns.
So it's not a suggestion anymore. It's a requirement to justify their existence on the exchange if they're not using their assets effectively.
Absolutely. That is what truly unlocks the dormant value we were talking about. These reforms are forcing management to use those massive cash hoards, divest non-core assets, and focus squarely on shareholder value.
That convergence, structural stability, mandated reform, asset backing is why we're so bullish. But like we said, you can't just buy the index.
Now, if you do that, you just get the big, well-known companies.
You need a highly disciplined filter to find the companies where the value unlocking is most immediate and profound. We call it the JStockRadio standard.
And this is where we shift from macro theory to applied strategy. We are looking for the absolute deepest value coupled with a huge margin of safety.
Okay, criterion A is all about deep value. We're focusing specifically on the price to book, or PB ratio, and we target companies trading below a PB of 1.0.
Which, for listeners used to U.S. valuations, is just,
Oh.
it's a key concept.
Mm.
A PB of 1.0 means the market is valuing the company exactly at the recorded value of its net assets.
Nothing more.
Nothing. In Japan, targeting PB below 1.0 means you are literally buying the assets, the cash, the property, the equipment for less than they are worth on paper. You're buying $1 for 70 or 80 cents.
And the size of this opportunity is just anomalous for a stable, developed economy. Over 35% of listed Japanese companies still fall into this deep value category.
Think about that. Just let that sink in for a moment. 1/3 of a world-class developed market is trading below its liquidation value. That kind of widespread, systemic undervaluation, it just doesn't exist in any other safe jurisdiction on Earth.
Okay, so Criterion B builds on that value by adding a layer of financial safety. Fortress balance sheets. We like zero-debt companies, but we are specifically looking for the extreme cases, the net cash giants.
The net cash giant concept is extraordinary. It provides just unparalleled safety. This is a company where the cash reserves, minus all their liabilities, including debt, actually exceed their entire market capitalization.
So let me get this straight. You could buy the entire company, liquidate just the cash, pay off all the debt, and you'd still have the entire operating business, the factories, the brand left over, effectively for free.
That is precisely what it means. It's the ultimate safety net. The company is completely insulated from interest rate shocks, from economic downturns. They have the firepower to do buybacks, issue dividends, acquire competitors.
Without ever needing the debt market.
Never. And when you find deep value, so PB below 1, combined with that level of balance sheet strength, you've found a truly defensive and undervalued stock.
And finally, we look for companies that aren't just safe and cheap, but have inherent mandated tailwinds. This is Criterion C national policy catalysts.
A crucial layer of synthesis. We don't just want cheap companies that are going to sit there for another decade. We want cheap companies that are explicitly aligned with massive, non-discretionary government priorities.
Right, something that provides a guaranteed tailwind of spending and political momentum.
Exactly.
So what are the specific policy drivers we're focused on right now?
The focus is highly targeted, reflecting Japan's modern challenges. So first, defense modernization. That's a huge priority. Second, infrastructure related to utilizing drones for logistics, surveillance, industrial applications. Big investment there.
And the third one is arguably the most critical for the long term, solving Japan's labor shortage challenges.
Absolutely. The demographic crunch is real. So any company providing solutions through automation, robotics, efficiency-enhancing tech, they're going to benefit from massive structural tailwinds.
So if a company meets Criterion A, deep value,
And Criterion B, net cash giant,
and happens to be active in one of these government prioritized areas, that's when you know you have a real winner.
that's a stock that is poised for immediate re-rating.
So let's synthesize this vision one last time before we wrap up. What does this all mean for you, the listener?
Japanese equities are offering something completely unique in the current global climate. You get asset-backed security that insulates you from these global growth bubbles like the one we see in the U.S.
And it's combined with structural reform that is being mandated and enforced from the top down by the exchange itself.
And crucially, that safety and that reform are combined with a profound, pervasive level of deep undervaluation.
This convergence of safety, mandate, and value, it makes Japan an unparalleled investment opportunity right now.
Our commitment through JStockRadio, driven by the insights from Shikiho, is to keep focusing on specific, undiscovered mid to small caps, applying those strict criteria. PV below 1.0, net cash giants, in alignment with national policy.
We've looked at the U.S. bubble, the flight of capital from geopolitical risk, and the specific filters you need to find safety and value in Japan. But this is really just the beginning of unlocking this market.
And we want to leave you with one final thought to mull over. We established that 35% of companies are currently trading below book value. And these governance reform mandates are forcing management to act over the next few years.
So if that combination of decades of untapped, asset-backed financial strength meets a clear, mandated requirement for corporate restructuring and shareholder returns, what does that imply for the potential returns on a basket of these deep-value Japanese stocks?
Compared to, say, the high-flying, growth-dependent U.S. equities over the next 5 years?
Are you positioned for the risk of the U.S. bubble deflating? Or are you positioned for the mandatory value unlocking that's happening in Japan?
That combination of structural stability meeting mandatory financial change. It's set to release a level of value creation we just haven't seen in this region for a generation. The choice is yours.
That's the deep dive, and this is JStockRadio. We'll be back soon with the next undiscovered gem.